All right, class, we're into chapter number 5, where we're going to learn the taxation of capital gains and losses. So here's some procedures we have to go through to figure out the tax on the gain or loss. So if you remember in previous chapters, we learned the two R words here. Realize means typically we have a sale that triggers the reporting of a gain or loss. Well, I shouldn't say reporting because here's the actual reporting here, that you have to report it on your tax return and pay taxes on the gain or be able to deduct the loss. You may still realize the gain or loss, but if you don't have to report the gain, it's unrecognized. Or you cannot deduct the loss, it's an unrecognized loss. We have to identify the character of the gain or loss. The character possibly could be based upon how long you've held that asset before you sold it, or whether that asset was used for personal use or for investment, or you bought it for using it in a trade or business. Maybe one of the harder things in calculating the gain or loss is how much you get to subtract out as a so-called basis. Typically, we would say this is the cost, but cost could be just one type of basis you get to deduct. So here's a simple formula. The so-called realized gain or loss, remember not necessarily recognized yet, is equal to something called amount realized minus the adjusted basis. So if you remember way back in your previous accounting classes, you sold merchandise, you had something called sales, and you minused out the sales returns and allowances and minusing out discounts, sales discounts, to get something called net sales. Well, this net sales figure is comparable to this amount realized. So here's your sales price, the gross sales price you get when you sell that capital asset, and you're going to subtract out selling expenses, selling costs. Things maybe like the commission you have to pay a broker to sell that item you just sold, or maybe legal costs to develop, to write up contracts. So again, the leftover now is going to be that so-called amount realized. Now we get to subtract out the so-called adjusted basis. And again, we're spending some time in this slideshow to figure out how much is this adjusted basis. And if the amount realized is bigger than the adjusted basis, the excess amount realized is a gain realized. Or if the adjusted basis is bigger than the amount realized, the excess is a realized loss. So now if this gain or loss is recognized, let's call that recognize, then the gain is going to be taxable. And we'll see different tax rates depending upon the character of the gain. Or if we have a loss here, the loss may be deductible, which is good, right? It helps us save taxes. Now, you don't definitely want to lose money, but if you do, you want that loss to be deductible to help you save taxes. So the opposite of recognize is unrecognized, where if you have a gain, the gain is tax-free. How good is that, huh? Free money. Well, free taxed money, untaxed money. But here's a bad situation. If you have an economic loss and it's unrecognized, you cannot deduct it. No tax benefit on this loss, like this loss. So the best of both worlds would be tax-free gain and deductible loss if you have a realized gain or loss. Here it says that the recognized gain is going to be put on the tax return, and of course you're going to have to pay taxes on it. But it's not just as simple as that, because we're going to see different tax rates depending upon the character of the assets sold. Here it kind of mentions that we saw in the previous screen that realized gain is always going to be bigger than or equal to the recognized gain, or just the opposite here. The recognized gain cannot be bigger than the realized one. Yeah. Okay, so how about if you have losses? I mentioned that possibly if it could be not deductible, yeah? Non-deductible. Typically that's for personal use, like that automobile you bought to commute and go to the market with. That's personal use. And if you sell it at a loss, it's going to be non-deductible. If you bought an asset for trade or business or for investment, and then you have a loss, possibly the loss will be deductible. Holding period, how long you held that asset up to the point you sell it. If you held the asset for 1 year or less, then the gain or loss is classified as short term. That gets taxed differently than if it were long term, meaning now the property you own before you sold it was owned by you, held by you for more than a year. Notice where the exact 1 year falls here. If it's exactly 1 year, it's short-term gain or loss. To be able to get long-term benefits, you have to own it for more than 1 year. Or sometimes they say 1 year and 1 day, just to make sure you own it for more than a year. Of course, we always have exceptions to the general rule. If you receive a gift, now you can add on the holding period of the person who had given you that gift. The person that gives you the gift is called the donor, and you who receive the gift is the donee. Gifts are made when the donor is living. If the gift or transfer is made at the death of the person that's giving the item, that's called a bequest or inheritance. Now the person giving that bequest or inheritance is called the decedent. Not descendant, yeah, but decedent, and the person receiving the gift is a beneficiary. And now, whatever you receive as a bequest or inheritance is considered automatically to be long-term, no matter how long it was held by the decedent or the beneficiary. If you exchange assets and it's tax-free exchange, then you can tack on the holding period of the old asset to the holding period of the new asset you acquired. And here's something you kind of learned in previous accounting classes. Yeah, stock dividends. When you receive more shares as a stock dividend, the holding period is considered to be the same as the original underlying stocks you had. So you're going to figure out the gain or loss by classifying it by how long you held it, short-term gains and losses, and long-term gains and losses. Remember, this is the gain is when the amount realized is greater than the adjusted basis. Here is when the adjusted basis is greater than the amount realized. Again, be it long-term or short-term. So you're going to do all these calculations for each sale or exchange and combine all the short-term and all the long-term. We call this netting, right? You don't add gains and losses together, right? You take the difference. So you're going to get a net short-term capital gain or loss. A loss if this total losses is bigger than this gain. Likewise, you take the difference here to get a net long-term capital gain or loss. So you don't add directly this loss and this loss together, right? You don't add this gain and this gain together. You first group them by whether they're short-term and then group them by long-term to get this net short-term and net long-term. Then you're going to, let's say we have 4 different possibilities here, right? Gain, loss, short-term, long-term. If you have a loss in one category and a gain in the other, you're going to net them again. Here, this gain with this loss, or this loss with this gain, to get a net remaining whatever is left over of each of those. Yeah. you do not eventually combine a net short-term capital gain with a net long-term gain. Maybe we add them up, but they're going to be taxed differently. But in the meantime, you're netting out gains and losses, eventually be it long-term or short-term in this order. It's kind of explained that netting here in this paragraph. Ultimately, if you have a net long-term capital gain, here it says that's going to be taxed at a favorable tax rate. The favorable rate is either going to be 0, basically saying tax-free, or a low 15% rate, or a relatively higher 20% rate. That's long-term capital gains. We're going to see some other rates, maybe a 25% rate and a 28% rate if the characteristic of the asset sort of it falls into a different category. Now, if you have a short-term capital gain, then that short-term capital gain taxed at regular rates, not this lower rates over here. If you have a net long-term capital loss or a net short-term capital loss, that means you already reduced your gains by the losses and you still have losses left over, then your leftover loss, be it long or short term, you can use 3,000 up to 3,000 of that losses for the year to offset the other income like wage income or interest income, dividend income. Yeah, you've already offset the capital gain income and you still have leftover losses. So now you use up 3,000 of the losses to offset other income, and any unused losses after that you carry over to future years, and you can offset capital gains in future years. And if you still have extra left over in those future years, then another 3,000 can be used in that future year to offset other income. And you can keep carrying forward your unused capital losses, be it short-term or long-term, for almost forever. Almost forever, because it stops when you die. In the last tax return you file, if you don't use it up, that loss is expired. The losses are wasted. So here's what we subtract out, right? Remember the amount realized, and we minus out the adjusted basis equals the gain or loss. So here's how we calculate the adjusted basis. Here's an initial basis. It could be the cost at what you bought something at, or maybe how you received it as a gift or inherited, yeah? And then any more things you added on to that asset, here they call it capital additions, versus not expenses or maintenance, yeah, but expanding the asset you own, and minus something called recoveries. Basically, this is the accumulated depreciation you back out. To get, in financial terms, we call this book value. For tax terms, we call this adjusted basis that we subtract out to get that realized gain or loss. So that initial basis could be what you bought it at costs, or we'll see different basis if it's gifted to a donee or received by a beneficiary from a decedent, or here personal use. Personal use could be the cost, but then later on you convert it to business use, and maybe the cost will carry over here, or maybe if the value at the time you do this conversion from personal to business, we use that lower valuation, fair market value amount. Here it kind of mentions that if you have one big basis for lots of different things you buy, you're going to have to kind of chop up the cost between all those different assets you buy. So cost, again, this is what you pay to buy that item, or even if you gave up a property, you're going to add to the cost of the new property the value of the property you gave up. In fact, you see this thing right here? This is a sale or exchange where you got to subtract out from this fair market value the adjusted basis of the thing you just gave up to acquire the new thing you just bought. Okay, so simple if you just pay cash, yeah? A little bit more complicated if you're doing a so-called maybe trade-in. And to that cost, you add in any shipping, installation, any cost of moving the item and getting it ready for use. I know it's been a while, but if you remember back in your second accounting class, probably that's the accounting 202 manager accounting, you spent a couple chapters in doing accounting for a manufacturer, a factory, like process costing or project costing. And if you remember direct costs like direct labor, direct materials, the hard one was the manufacturing overhead. Well, if you manufacture an asset that you're going to either resell or use in your company, all of that cost has to be what we call capitalized, treated as an asset. And you only get the benefit of the cost when you start depreciating it, or when you sell that asset, you get to subtract the costs, not at the time you incur the costs. Likewise, typically in a construction project, you have a construction loan versus a so-called takeout permanent loan. So during the period that capital assets being developed, the interest you pay, any financing costs you pay, has to be added into the cost of the construction of that asset, and you cannot deduct the interest right away. You deduct it either as depreciation if you use that asset you're building in future years, or you deduct it at the time you sell that asset. So let's take a look at the taxation of selling stock investments. So no question, if you buy a bunch of stocks and sell the whole thing one time, you get to deduct all of the costs. But if you buy separate lots of the same stock, then there's a different order you deduct the costs. It pretty much follows the calculation of, if you remember the costing of inventory, we saw the term FIFO. There's no LIFO here, yeah, under for taxation of the selling stock, or average method, or specific identification method. Yeah, so real simple if you buy and sell everything of one of that shares, yeah, of that company's stock. But if you buy, let's say, Google stock, Alphabet, and you buy 100 shares at, let's say, $80, and then you buy some more 100 shares at $90 and 100 shares at $100, and you sell just 50 shares, what costs are you going to use? Are you going to use 80 times 50, or 80 times 90, or 80 times 100? Well, if you don't identify which of the 50 shares are coming from this 300, tax rules say you got to use FIFO. In other words, you subtract out the old costs here, yeah? Now, if you sell all 300 one time, no problem. You get to deduct all of these costs, yeah? Now, if what you're doing, oh, and if you can use a specific identification, if you want to reduce your gain, you say, I sold over here, yeah? But you got to tell your broker it's coming out of this lot here versus this lot and this lot. Keeping in mind that we're talking about all of this investments in one stock account, one trading account. If you have Google stock in one account, trading account, and then in another account, you cannot mix up the costs here, yeah? But if it's all in one trading account, now you got to identify, otherwise you use FIFO. So people like to invest in mutual funds or exchange traded funds. Again, you're buying more shares of this ETF or mutual fund and buying some more and buying some more later on. And again, if you don't, well, probably the broker will use the average cost method in identifying costs. The main reason why is because it's easy. It's very common to buy more shares in a mutual fund because of dividends being reinvested. Same thing with the ETF. Could be even for stock, the so-called dividend reinvestment program. You buy more shares using dividends, yeah? And most times the broker will use FIFO if you don't identify which lot here for stock, and we'll use average cost method if you don't identify which ones you want to redeem. So let's say that you're going to sell an asset that you received as a gift. Again, the person giving the gift is called the donor. The person receiving the gift is called the donee. And you have to identify the date you received the gift and what was the so-called fair market value at the time of the gift was made. You also have to identify the date the donor got the asset and how much they acquired it at, or their adjusted basis. So this is not the easiest flow chart to follow, so I'll try to interpret it for you in English here. So here's the gift being made, and they're asking whether the value on the date of the gift is less than the donor's, this person's here, adjusted basis. Let's go the easier question here. We're going to say no. In other words, the fair market value is bigger than the basis. That asset has increased in value while the donor had owned it. Okay, so we're going to go down, and let's assume there is no gift tax. Remember, we're doing income tax in our class, yeah? In our class, not gift taxes. So we're going to say no, and here it says that the donee now is going to have a basis in that property equal to that of the donor. Also, the holding period of the donor will be tacked on to the holding period now of the donee. Okay, so that's the easiest situation. So eventually when the donee sells that asset, they just use that old adjusted basis of the donor. So let's go the opposite here at the date of the gift. Is the value of the gift less than what the donor had acquired it at? And we say yes. In other words, the value has gone down since the donor owned that property. So here now when the donee sells the property, is the sales price of for the donee greater than the value at the time of the gift was made back here? And if we let's say no, okay, let's go to the opposite here. It's went down in value here and went down in value some more, so we're going to go over here. So you know you're going to have a loss. You're going to have a loss. The question is now, what is the basis you're going to use for that loss? Here it says to use the value at the time of the gift in calculating that loss. Okay, there should be no gain here. It's gone down in value, gone down in value. So you know you have a loss. And I guess the IRS wants you to have a smaller loss to deduct, yes? So they use this higher value here as your basis. The higher value as your basis here, okay? So let's go the other way here, which is a little bit more tricky. It's gone down in value at the date of the gift, but it's gone up in value since the time the donee received that gift. So here it says now you're going to use the adjusted basis of the donor to figure out the gain to the donee. Okay, went down in value here and went up in value here. And here's the gain the donee is going to report. Now there's a situation where the costs, well, the sales price here is going to fall in between the reduced value here compared to the adjusted basis of the donor. In that situation, there is no gain or loss to the donee. In other words, here's the sales price for the donee. Okay, let me grab my notes here. So we compare this with the donor's adjusted basis. And this donor's adjusted basis is greater than this sales price to the donee over here. And here, again, is the donee's sales price. And we compare that with the fair market value of the gift here by the donor. So if your sales price falls within this range and this range here, and the donee sells it, no gain or loss to the donee. Here, if the sales price is bigger than the donor's basis, then gain using this old basis over here. Here, decrease in value, decrease in value. You're going to use the fair market value at the time of the gift to get a smaller loss over here. Okay, so gain, loss, no gain or loss. Let's use an example from the textbook to illustrate this example. So we have Chuck. Chuck makes a gift of property to Maggie. So Chuck is the donor, and Maggie is the donee. And basis to Chuck is $600. In the time of the gift, the property has gone down to $500. Maggie's basis of the property is $600 if the property is sold at a gain. But if she's going to use $500 if the property is sold at a loss. So here is that using my this right here. Donor's basis is 600. That's greater than, we'll call it the sales price for Maggie, the donee, as compared to the donor's value at the date of gift, 500. So in other words, if Maggie sells her asset between 600 and 500, there is no gain or loss. If Maggie sells her asset for more than 600, now we have a gain using this $600 basis. If Maggie sells that asset for less than 500, she's going to have a loss using this as the basis. Again, in between these two prices, there's no gain or loss to Maggie. But it all goes back at the time of the gift. Because the value has gone down compared to the basis, we use this rule when eventually the donee sells that gifted property. Let me go back to the simpler situation. If we reverse the amounts here, if the cost was 500 to Chuck and it was valued as 600 at the time the gift was made, then you're always going to use the 500 costs no matter Maggie sells it at more or less than that. But because the value went down at the time of the gift, now we have this fuzzy rule here. This is not a common situation because of the estate and gift tax exemption, almost like you can give away during your life and death a combined of over almost $5.45 million. But if you have a rich client, or even yourself, hopefully, you're giving away $1 million of gifts, then you're probably going to have to pay gift taxes. And here it says that possibly part of that gift tax is going to be added to the basis to the property you're giving. So the donee will get an additional cost to deduct if they eventually sell that property. Don't confuse this word here with descendant. This is decedent. This is the person that just passed away and they're giving through an inheritance or bequest property to a beneficiary. So you look at the date of death of this decedent and all the value of properties they own at that date. And that's the basis now that the beneficiary will use. So typically, if you have especially real estate that was purchased a long time ago at a low price, yeah, a low basis. And if the taxpayer sells it, there's going to be a gain. So what they want to do is leave this property to their uh, descendants, the beneficiaries, not decedent. Yeah, the decedent again is the person that passed away, and on their date of death, whatever value, high value the property now is worth, that's going to be the cost basis of the property. So we call that a step up in basis. So now if you sell the property at that value, your gain would be zero, and there's going to be no taxes to that beneficiary. Hawaii is a common law property, yeah, not community property state, so we'll ignore this rule here. So let's say that you purchase or acquired personal use property, meaning you use it not for business or not for investment. And then later on, you convert it to business use. So maybe a typical example is you buy an automobile for your own driving, commuting, and then you contribute it to a business. Or a common situation is you have your personal residence, you live here, and then later on you convert it to a rental property. Well, what you have to do is the time you convert it, you look at the value of the property and you compare it to the original cost basis and you use the lower of the two. It's almost like that gift rule we saw a couple slides ago. So if you buy a whole bunch of assets, typically this would be something like you buy a whole business and there's lots of assets within the business. Or a common one for real estate is you buy, let's say, the land and the building. Am I drawing a building here? And inside this building is equipment or furniture, and you buy the whole thing as a package. Well, now you got to allocate the costs to the land, to the building, and to the equipment. So what you do is you get an appraiser and take the value of each of these items, and the percentage you multiply it by the original total costs. And that's how you allocate now the cost to each of these items. Of course, we know the cost allocated to land just sits there. You don't get to depreciate it. You only get to deduct it at the time you sell the whole property. Or here you have building that gets depreciated, but at a slower rate over a longer life than that of the equipment that's inside of this building. So if you have a friendly appraiser, what you want to do is try to, as much as possible, allocate costs to items that you can deduct relatively quickly as compared to items that you have to wait to sell it before you get to deduct it. We've seen stock dividends in previous classes. Basically, it's saying that it's usually non-taxable. Although we talked about large and small stock dividends, yeah. But now this is the side of the shareholder, not the corporation, and stock dividends are non-taxable. But you now have to divide up the total cost of the original shares among all of the shares now. So each share has a lower cost, but the total cost is still the same, but now you're sharing it among more shares of stock. Again, no problem if you sell all of the shares at one time. You have an allocation issue now if you sell only smaller amounts, a smaller lot than the original. Not too common, but stock rights is like a spin-off of the stock, and generally it's a non-taxable event. But if you have, there's probably three different situations. The rights will expire, in other words, you don't use them, or you sell the rights to someone else and you make a profit, or you exercise the rights and you buy shares using those rights. Here it says the situation of how to handle that now, taxation of the rights. So the main thing, the title of our chapter is Capital Gains and Losses. And you get capital gains and losses when you sell or exchange capital assets. So Internal Revenue Code 1221 defines a capital asset by a negative definition, telling you what's not a capital asset. All of these are not capital assets. So if you don't see it on this list, then it is a capital asset. For example, we've seen in our previous accounting classes, you buy and sell inventory. Well, for tax purposes, that's going to result not in a capital gain or loss, but ordinary gain. Hopefully not loss, right? You want your gross profit to be a positive number. 1231 assets, we'll see in another slide that this is business assets, not inventory, but equipment, building, land. Typically things that get depreciated, and land. And maybe part of the gain or gain on the sale of a Section 1231 asset could be treated as a capital asset. Possibly it could be treated as ordinary income. Possibly it could be treated as something called unrecaptured Section 1250. We'll talk about that in this and some other chapters. So let's say that you make a sale and didn't collect the money right away. If you're cash basis, you don't report the money, right, until you collect it. So you have this account receivable you're sitting on, and if you collect it, then it turns into ordinary income. If you sell it to someone else to collect it, then it turns into ordinary income, not capital gain income. When you buy supplies, you deduct an ordinary expense, not a capital loss, yeah? So if you sell supplies, ordinary income. I don't think this is something, well, maybe this is more like literature, but all of this stuff here is developed in someone's profession, someone's job, a poet, an author, a musician, an artist. They're creating this. So typically that's just like a job where you have ordinary income versus a capital gain income. An exception is music here on the next slide. The creator can elect to treat it as a capital asset. 1231 property, again, is used in business. Usually it's something that's depreciable, like a building, like equipment. Also, land falls under this category. And when you sell that business property, be it at a gain or loss, it first starts off as a Section 1231 gain or loss, and you combine it with other Section 1231 gains and losses. We're going to see in a future chapter something called recapture, and they'll turn it into ordinary income. And somewhat in this chapter, we'll see something called unrecaptured. And the unrecaptured gain will be taxed at a maximum 25%. Hopefully we'll see the calculation of using this 25%. Let's see, here they talk about recapture, turning the gain from maybe capital to ordinary. So here's some exceptions again to capital gain treatment. 1244 is a stock loss that's treated as ordinary versus a capital loss. If you have a loss, you want the loss to be ordinary and not necessarily capital for the best tax treatment. This is kind of a subjective area. You have people called traders, and when they do their work, they have ordinary income. And when you have on the other extreme, you have people called investors, and if they buy and sell stuff, typically this is a capital gain or loss. Then you have people kind of doing both here, dealers. So if they have losses, you want them to be like traders, get ordinary losses. If you have gains, you want them to be like investors, so you have capital gains, possibly long-term capital gain treatments. So that situation kind of pops up over here. We saw in previous chapters where you subdivide a property and possibly for the first 5 units you sell, you can treat it as a capital gain, yeah, versus ordinary. Business bad debts is ordinary deduction, which is good as compared to non-business bad debts, which is treated as a short-term capital loss. And we'll probably will see this in a future chapter. Let's stop here and then continue taking a look at part 2 of this video lecture for chapter 5.